Welcome back to another day in the market, and as you can see, not only has it been a bloody day today, down 1.65% on the S&P 500, we are having a huge downturn on the week ahead. So why is this happening? Is this good or bad news? We're going to get into all of that, plus some pretty significant update on the Fed and everything with interest rates. So before we get into that, we're going to start with some macroeconomic news and then get back to the charts. So first and foremost, the fear and greed index. We are in fear right now. 40 it looks like. I think the micro has it as 46 to be a little bit more specific. And this is a really interesting chart that you can see. It's on micro. You can check it out yourself if you like, but we talked earlier or previously about a week or so ago that you can actually have some pretty good buy indications based on where the price action of the S&P 500 is in relation to the fear and greed index. We also talked about how there was a little bit of a support here. We did see that support come back up, and it looks like it is failing, suggesting that there is actually going to be a little bit leg down. Now, as far as an entry position, if you were just kind of looking at the fear and greed index as an indicator to do so, the lower the fear is, or the greater the fear, so the lower the score is, the more likely you are to have a really good price point for the near future, as well as the distant future, right? So the lower this thing drops, the better buying opportunities there are. And the put to call ratio. So you can see a huge spike on the puts here. And this one you want to look at in the sense that this is telling you overall market sentiment, right? Generally, so it's going to kind of be similar to the fear and greed index. This huge spike here is putting more pressure onto the selling side than it is the buying side, which gives an advantage to the bears. So a couple indications that we are heading lower. And so the question is, what has happened in the past couple of days? Because if we go down to the daily chart, you can see a free fall here. Well, a couple of things. One, from a technical standpoint, we actually crossed below the MACD right. Zoom in a little bit. Right here on this day that went flat. It went flat. I think it was down just a little bit. And that just tipped the MACD and the RSI to under the zero line, which a lot of traders look for as far as indication of whether or not to go long or short. So that right there, from a technical standpoint, was a huge indication for a lot of people to start either selling other positions or going short. And you can see it actually is technically a low right here on these triangles, which point out the above and below the zero line as far as the MACD line, right? So once that blue line crosses, we get a signal. So that is another indication. On top of just a lot of this profit taking right here, you can see a trend line heading down, and you can see a trend line heading down. So not looking good. Now, as far as news, we can pull up this article here. And stocks slump and bond yields climb on Fed jitters. So the S&P 500 today is down 1%. It's actually down 1.65%. The Dow Jones Industrial Index is down 0.52 and NASDAQ down 1.17. So a couple of things to point out. First of all, U.S. weekly initial unemployment claims unexpectedly fell 20,000 to a 7.5-month low of 201,000, showing a stronger labor market than expectations of an increase to 225. So that is, as far as the stock market and just getting back to that normal and not having to deal with the Fed raising rates, this is not good news. Unfortunately, it's bad news for people that get laid off to have a higher unemployment. As far as the market is concerned, getting prices back down, that is not good news, more or less. So that's definitely one factor. And then it says here, stocks today extended Wednesday's losses as a hawkish tone of Wednesday's FOMC meeting is undercutting global risk sentiment. The Fed on Wednesday signals one more 25 basis points rate hike this year and saw less easing next year, with the median forecast for the federal funds rate at 5.1% by the end of 2024, up from 4.6% when projections were made in early June. So basically what it's saying is the market was kind of believing that once we were going to have one or two more basis points, and then we were going to kind of pause for a couple of months, and then 2024 we were going to start to lowering interest rates. I don't know where people got that from and why they thought that was the case. I've even heard loan officers talking to them actually saying, oh, this is when this is going to happen. This is when these interest rates are going to go down. And no one knows. It's based on so many different factors. Inflation, oil is having a huge impact on it. There's been less production. Because of less production, the U.S. is buying reserves, which is then eating up the supply. And oil increases the rates or the prices of everything: food, transportation, just clothing. Everything is impacted by oil. So people just speculating and having a rough timeline is fine, but definitely buying and selling based on that news or that speculation, and then just doing a complete 180 and having the market just completely free fall because it's the Fed comes out and says that they're going to start holding, or they're going to hold interest rates for longer than what they anticipated, and then start decreasing later into 2024 or maybe even beyond. The fact that people were buying off of the other news and are so shocked at this news is kind of unbelievable to me. With that said, this is an amazing opportunity for a trader if you are patient enough. Reason being is because if you missed this run back in April of 2023, first of all, I don't blame you, because look at the market before it. There was some suggestion, sure, that we had turned things around. We had this line right here kind of break, so I don't blame you for getting in. It was amazing. But we were coming off of this. There's a lot of fake outs with the HA market bias indicator if you're using that, but even if not, other indicators can fake you out. I think this guy right here faked everyone out on just about every indicator, which is a big reason why I really like this setup, because it's one of the few setups that didn't get faked out by that. Anyways, as I'm saying, this is a huge opportunity because everyone, that was the S&P 500, you go to NVIDIA, you go to AMD, you go to Tesla, everyone is just so overhyped. And we talked about how it's too late to get in if you miss that run, but yet there's no signal to start going short. So if you are interested in going short, you can get in on the 4 hours. Right here, you can see after this huge run, there's finally red. Now, there was red a little bit before when that trend started to change. So again, keep that with a grain of salt. But you go back to the S&P 500 on the 4 hour, you can absolutely play this. We are probably going to see a bounce. We did break this level right here, which was pretty big, which is probably why we continued to go lower after we broke. We're probably going to bounce back up a little bit. And those green days are actually the days where you have a great entry position for a short. And you could ride that all the way back down to, at least this line right here, so you can see something kind of come up like this here. Zoom in, kind of come up and then fall back down. Something like that, maybe. It could happen. There's a good chance it'll happen. But with that said, let's get rid of that real quick. With that said, this is a great opportunity. I would really actually love to see this green market bias indicator turn red, because that is going to, when it turns green again, that is going to give us a really, really good launching pad. And look, to go short right now on a lot of these stocks, AMD, Nvidia, the S&P 500, Tesla, naturally they're just going up, right? So you are going against the grain, even though the indicators are telling you to go. But if you miss this launch, like I said, it gives you a reset, because we're now coming back down. Now we're in all indications, as far as indicators are concerned, a bear market. And then once we get that those signals back, we get the green market bias indicator. We have the blue 7-period simple moving average above the 25-period exponential moving average. We're green as far as the MACD crossing above the 0 line. And that just really gives you a nice launching pad if you missed it the first time, okay? So also it gives you a good opportunity to start scaling in if you just want to DCA and you want to play it well. A final reason why this is really good is because we talked here. Let me pull it up real quick. So we talked about this logarithmic regression band right here. And if we zoom in, you can see Bitcoin has reached the bottom end of its logarithmic regression band, suggesting that this is a very good time to buy. Now, you can probably expect Bitcoin to follow the market and go even lower. So we could even go one more leg down and be pretty significantly below this line, which would be, this is Benjamin Cohen's website, by the way. He's an awesome YouTuber. Check him out, intothecryptoverse.com. It would be an even better buying opportunity than what this current logarithmic regression is suggesting. On top of it, you have Ethereum, who has been flirting with the idea of getting into there since its last bull run, but has not yet. And if this even just trickles along, but if it follows the market and comes down, we're actually in that lower band, and it would be a great buying opportunity. And there has been a lot of theory about a final leg back down. It would follow very nicely with previous bull runs, and the end of a bear cycle is you're getting a leg up and then a leg down and then up again. So that is similar to the previous experiences, and that would follow very nicely. So there's a lot of things that are going into this market downturn. It feels like there's just one more thing that needs to happen, or is going to happen, I should say, it's a better word, to just let everything finally get to where it has been leading towards based on what the Fed has been doing, and that is some sort of economic slowdown. That is not great for a lot of people. It's just unfortunate that high inflation affects everybody, and the way to correct it is to get the balance of the amount of money that people have and the unemployment and everything back to its normal range, right? To slow the inflation. So they're aiming for a soft landing. They're trying to avoid a recession. I think a recession is probably going to happen, but it doesn't necessarily have to be a bad one. We all remember the 2008 recession. It doesn't have to be that. So that's all I got for you. If you like this video, hit the like button. Is the easiest way to help out the channel. Otherwise, hit the subscription button and turn on the notifications so you can see all of my latest content. Until then, we'll see you next time. Thanks.